Good morning and happy holiday to everyone. I'm Morgan Brennan. It is March 29th, and we will get key inflation data in just about 15 minutes. We're doing this live stream on CNBC.com to make sure you get the news, the number, the analysis when the personal consumption expenditures price index comes out at 8:30 a.m. Eastern. Now, there are no futures today. There's no trading. It is Good Friday. The markets are closed, but our reaction Monday morning is not only certainly possible, but very likely. So joining me now this morning, senior economics reporter Steve Leisman and Rick Santelli, who is live in Chicago. Gentlemen, good morning. It's good to be here with you on this Friday morning to break down this key number. Steve, I mean, you're our econ wonk, and you are the resident Fed whisperer at CNBC. So let's kick it off with you. What are you looking for in this PCE report that we know is the Fed's preferred inflation gauge?
Yeah, well, it's going to come in around 0.4 or so, 0.3. One thing that sort of speaks against the surprise, Morgan, is the economists who don't do a whole lot of forecasting all that well are actually pretty good at putting this number together. They take the CPI, they take the PPI, that's the wholesale report, and then they come up with this. And what this is, ways different is there's different weightings to it, different ways of looking at the inflation data in a way that the Fed thinks is a better guide to policy, I guess is the way to put it. So it's going to come in a little bit hotter than it's been. I was actually just looking. We have gotten 6 of the last 8 reports have been at 0.2%. Very benign. And some, of course, even lower than that. And so I think the story here is that it's another month. There we go, 0.4 on the headline, and then go down to the core 0.3. The trouble with that core right there from a Fed perspective is it doesn't change the year over year. Now, to be fair, the Fed kind of raised its or lowered the bar a little bit at the last meeting. The average forecast is for a 2.6% inflation rate this year. So they have a little bit more leeway. They're maybe closer, getting close to where they were, which is why you had Powell saying that the recent inflation in the last couple of months hasn't really changed the story. I think that's a big part of it. We can talk a little bit more about Powell and maybe Powell versus Waller a little bit later.
Ooh, and I would love to do that. First, though, Rick, to bring you into this conversation, I mean, one of the other things that folks seem to be really focused on here is the possibility of January revisions. And if we see those revised higher, what that does this 6-month annualized at a time where, pretty incredibly, we saw another record high on the S&P 500 yesterday. We ended the first quarter, but, oh, by the way, we also saw Treasury yields move higher in the last 3 months as well.
Yeah, I think when you look at Treasury yields, there's a couple of different ways to look at it. If you look at prior to the beginning of this year, we made a big run towards 5%, even though we came within a whisker of actually trading 5%. But for 2024, the high yield close for 10s is 4.32. And the reason I bring that up is because we are hovering very close to that, especially when you consider the two big numbers to kind of look at 2024 in context, is that 432 high yield close, and by the way, it's a double top, versus 388 where we settled last year. So we're definitely in the upper part of that range. I think that's significant. The other thing very much significant to this number is that when you look at personal income, last month it was 1%. That was the best level since July of 21. That is a big part of this as well. It isn't only a story about inflation and the Fed's inflation metrics. It's also about income and spending. We don't want to forget that. If we look at the 2 year-over-year numbers, 2.4 on year-over-year deflator and 2.8 on PCE core deflator year-over-year, both those numbers are basically at the lowest levels in 3 years. For the deflator year-over-year, February of 21. For core deflator year-over-year, March of 21. So we have made steady progress. That's not the problem. My interpretation is that, yes, we've come down, but it seems like it's starting to plateau. And 2.4 and 2.8 aren't 2%, and those are the forces the market's going to have to reckon with, or more importantly, Jay Powell and company are going to have to reckon with.
Which brings us back to what you...
Morgan,
yeah.
I want to pick up on that because I think Rick makes a really important point, which is I'm as interested this morning in the consumption numbers and the income numbers as I am in the inflation numbers. Because think about the trade-off the market's making here. It's been one we've been following very closely, which is, we're hyper focused on this PCE inflation number to figure out, is the Fed going to cut a quarter here, a quarter there, go in June, not go in June, go in July, whatever. On the other side of that trade is better economic growth. And Rick was right to point out the strength we've had. I don't know if we're getting this slowdown that economists keep saying is just around the corner, but it hasn't really happened recently. So I'm fascinated this morning to see what is the strength of the consumer, what's happening on the income side, what's happening on the savings side, because all of this stuff, like a castle you might build in the sand when it comes to the Fed here, it's washed away by strong income, strong spending, and stronger GDP growth.
How does the fact that we've seen financial conditions, Steve, loosen through this process, everybody talks about the so-called Powell pivot. It really did start with Waller back in, November of last year, and then Powell kind of piled on. You saw the markets really reignite and at least stocks reignite and rally as well. And then to your point, Waller perhaps walking some of that back a little bit earlier this week. So how does that play into this picture here? What I guess is essentially a gratuitous circle in terms of the resilience of the economy and how consumers are feeling about it.
Well, a little bit depends upon what time period you're looking at. Over a while here, and Rick will speak very intelligently about this, is you have had higher interest rates. You're talking about 10-year yields that were much, much lower. They came up quite a bit, and then they've come down since then. You had the markets come up quite a bit. And so in that sense, financial conditions are easier. But Waller was speaking yesterday, and he was talking, I forget what time frame. He goes, hey, they're 60 basis points higher than they were at some point in time. So that's one way that they look at it, which is over perhaps a longer time than we look at it. But it is something that's probably helping the economy. It certainly tends to help wealthier Americans more so than middle or lower income Americans. But you do have 50, 60% of the public are invested in the stock market, so they get some help from that. So I would say financial conditions are easier overall. It's helping the economy. I don't think the Fed is particularly
Steve, we're 200 basis points. Steve, we're 200 basis points or thereabouts against 10-year boons. Okay, 190 to 200, right
higher.
in that area.
You're saying higher.
I find that
higher.
very.
Right.
Oh yes, higher. We're basically hovering. Let's say, and markets are closed at 4.25. They're hovering around 235, 237, somewhere in there. But I find it so fascinating how little that is talked about, how much higher our rate structure is, how much better the economy is doing, and how every central bank just seems to mimic what we do. I know that, imitation's the highest form of flattery, but if you look at all the patterns, whether it's boons, whether it's gilts, treasuries, even though the price structure is different, the movement is exactly the same. Any thoughts there?
Well, I only a weird one, Rick, which is I've always wondered why, when I went to go look for a mortgage, money was most expensive in New York, which was the financial capital of the world. And then I look around the world and I wonder why money is more expensive in America, which is the financial capital of the globe. I don't quite get that. Our inflation rate is lower. Our growth is bigger. We were further ahead than other countries.
That's a GDP,
I don't
maybe?
understand this. Yeah, I don't understand the differential here, Rick. Maybe you have a better explanation.
Yeah.
The dollar's been doing very well, and that's really helped buoy everything. So we'll leave it there.
Yeah. I do want to bring another voice into this conversation, and that's Diane Swonk, chief economist at KPMG. Get her thoughts on this, too, as we do await this number and tick down 6 minutes until that news crosses. Diane, your thoughts on this, especially as we did just finish the first quarter where yields were higher, stocks were higher, gold is higher, and the dollar was stronger.
Well, 2/3 of Americans are feeling more wealthy, and that shows up in home values and in home ownership. Of course, people can't buy the homes that they'd like to buy right now. We've got 12,000 millennials a day turning 35, moving into their peak home buying years, and they want to buy homes. So that is something that they feel locked out of. That said, the minute it's almost dry tinder, the minute that mortgage rates dip below 7%, you see demand spike even though it's still highly unaffordable to buy a home today. And that is something the Fed is watching as well, is what is the dry tinder in the housing market, given the constraints on supply relative to demand. And I've never seen anything more emotional in my X feed or Twitter feed or whatever it is. And Steve, I know for good reason you've left the platforms in some ways, but it really is an emotional issue, is the shelter costs, and it is unaffordable. That's something that we're seeing. That said, the resilience of the U.S. economy, the ability to hedge against higher rates by locking into low mortgage rates, and the ability that we had in terms of excess savings to cushion the blow. That 1% increase in income in January is important, but it was also buoyed by a big increase, not as big as it was in January of 2023, but a big increase in Social Security payments tied to the CPI, the cost of living adjustment that helped to buoy January. But it really is important because over 70 million people are now getting that extra bump in Social Security as inflation cools, but it doesn't cool. They're now finally getting a bump that's not so tepid, and that added to spending last year, and it's adding to spending right now. What I'm really looking for, as Steve said, is the underlying consumption patterns. Is there more strength in services, like we saw the upward revisions to the fourth quarter? The fourth quarter with a big upward revision was mostly in services, which actually accelerated overall consumer spending, accelerated in the fourth quarter from the third quarter. That's stunning resilience and defiance by the consumer. And I think Steve is right in terms of the Fed is looking at that strength and sort of weighing is that going to cause a floor to form under inflation? In Waller's speech, he repeated what he said in February. What's the rush?
Diane, it's worth pointing out that Waller the other day said he didn't think the job market was weak enough to or was too strong to really help in bringing down inflation. You know, he was pretty hawkish, and he was more hawkish the way you think about it, Morgan, relative to Powell. Powell said, hey, the last couple months hasn't changed the overall story. Waller came forward and said the last couple months has changed the overall story. So it's going to be interesting. And I kind of thought that those Fed folks who have spoken since the meeting have been more on the Waller and hawkish side, which is kind of unusual for a Fed chair that has such strong control of his committee.
Well, and that raises the question about what kind of commentary we're going to get from Powell when he speaks with San Francisco Fed President Mary Daly later today at an event out there as well.
Yeah, it's a good Friday if you're a Fed watcher, Morgan.
Yeah. Rick, want to get your thoughts on this?
Well, you know what? Here's my issue. That whether it's Waller, whether it's Powell, in the end, once again, the verbal guidance is a way to, in my opinion, keep the equity markets kind of with that carrot, the carrot that's coming down the road. Whether it actually comes or not, no Fed official knows what these numbers are going to be down the road, 6 months, a year, with regard to inflation. And with regard to 2/3 of the population feeling wealthy, I'm not going to dispute that, Diane, but what I will definitely point out is that at least half the population that I deal with anecdotally is just looking at the sheer change of the inflation, the price of things from pre-COVID to now. Yeah. And until we see minus signs in front of all these data points, that things are, this is really hurting. And if you're looking for the president's poll numbers to go up because we're fighting inflation here, it's not going to happen until we actually see disinflation. And I don't think Powell would like that.
Rick, I think the absolute issue is the level of prices versus the pace of change. We're talking about decelerating inflation, and you and I know what that means. But, you know, people out there that are still buying things are saying they really would like to have 2024 wages with 2019 prices. Let's face it. That's not how the world works. And it takes time to catch up on what was lost in terms of inflation. And even if on average they're slightly ahead, they're still feeling like they're trying to see increases in their living standards with stronger wage gains outpacing inflation. And that takes time to feel like you've regained the ground lost. And most notably, we've seen wages slow the most in the sectors that had leveled up and finally had these low wage workers that got to move from the shadows of the economy that were non-essential become essential, move into the sun only to get burned by that inflation. I absolutely agree with you on that. And I think that's why people are so angry about the shelter costs. Even though rents have come off their highs and are resetting, it's still unaffordable for far too many to even rent. We have rising homelessness among the working poor. These are working homeless. That is really hard to digest. Between 2019 and 2022,
Diane, I'm going to cut you off right there because we do have the number crossing. Rick has the details for us.
All right, here we go. The big moment we've all been waiting for, our February read on personal income and spending and all those inflation numbers. On the headline, as Steve pointed out, expecting up 0.4%, comes in at up 0.3%. Now, the revisions aren't showing yet, but maybe as we go through the rest of the numbers, they will. Personal spending up 0.8, up 0.8. That is a stellar number. 0.8 is the best number going all the way back to January of 23. If we look at real spending, up 0.4%, that is the best level going back to December of last year. And if we look at the deflator month over month, up 0.3 as expected. And here we go. Year over year deflator, 2.5, 1/10 higher than 2.4, which was the lowest level since Feb of 21. This is 1/10 higher than that, but as expected, it really does break a streak of numbers moving lower. Now, let's look at the PCE core deflator month over month, and that is up 0.3. Definitely less than 0.4 in the rearview mirror, as expected, and my favorite is 2.8 on the PCE core deflator year over year. 2.8 as expected, which means it remains at the best levels since March of 21. Okay, revisions are coming in now. I'll hit the ones that are most important. On the year-over-year core I just went over, last month's 2.8 now becomes 2.9, so we're actually lower. But if I was the market right now, Steve Leisman, my guess is that these numbers are generally as expected, but we're not making progress on year over year, so the markets are going to have to fight that out.
Steve, want to get your reaction to this as I hear you say,
wow. Add to that.
Rick, you are the market, Rick. I don't know if you were the market. You are the market, man.
Today he's the only market.
Look, it's chill on the inflation numbers. It's hot on the consumption and the spending side. As far from what I could tell, I'm just income was 0.3, but outlays was 0.8. I mean, that's blowing me away. What did you say, Rick, about real spending was up 0.4%? That's inflation adjusted.
Yes,
is that 0.4%.
Yes, 0.4%.
Diane,
exactly right.
All right, Diane. Right here on TV, putting the pressure on you. Is this going to upgrade our first quarter GDP numbers, isn't it? What do you got? Can
Absolutely.
You do it on TV?
And in fact, I'm looking at the.
Do it in your head.
I'm doing in my head close to 2.5%. I'm thinking on the first quarter. So how's that for you? But I do think what's also important to remember, Waller pointed this out as well, and it's where everyone had declared victory. And Rick, you're right on the year over years, but the 3-month moving average, the 6-month moving average on all of these figures has moved up with these numbers, as far as I can tell, with the revisions as well. They've moved up. That is the wrong direction on momentum for the Federal Reserve on CPI, and with that strong consumption number out there as well. That's going to be, we already have people staking out the sort of pushback for a June cut. What's the rush? Wait a little longer. 9 of the 19 participants wanted 2 or less cuts, and it's only 1/4 point move by one person within that meeting that brings it down to 2 cuts for the year. I know that's splitting hairs, Steve, but the timing of rate cuts keeps getting moved out. We need to see a lot of improvement in terms of inflation in March before we get to a June cut, but also a big slowdown in employment.
I'm shaking my head, Diane. Diane, I'm shaking my head because I don't think this market needs to see anything from the Fed. The way they've been trading, it's been quite remarkable, right? I mean,
well, the market may not. I'm talking about the Fed.
Fed. I'm right. A very significant. I'll let Rick and Morgan talk about this, but But I just point out you've had a really significant reset on Fed expectations, down 300 basis points for the year-end funds rate over the course, and stocks have gone up and hit new highs in that context. And I think that's the context for everything we're talking about here today.
All right,
so if a cut's still on the table, is a cut still on the table, people, let's vote. If a cut's still on the table for 24, considering all the political issues with the election, that seems to keep the equity markets happy. It's when we get to that intersection where if we're not going to do the April-May meeting, which I don't think we are, let's say June's in play. Right, and let's say that June... Right, I think one cut's even enough. I think one cut's enough. But I think if we get down to the point where it's one cut and the equity markets slip a little bit but stay within 3 to 4% of the all-time high closes that they've had, that then all these numbers will take on a monumental importance. And just real quickly here, not that it changes anything, folks, but we want everybody tuned in to get every detail. I will go through the 4 revisions very quickly. On real spending last month, that's the only revision that actually got taken in the wrong direction, from minus 1/10 to minus 2/10, okay? But all the other metrics are inflation metrics, and they actually went up a 10. So PCE, right, deflator month over month was 0.3 last month. It's now 0.4. The PCE deflator month over month core went from 0.4 last month to 0.5. And as I pointed out, the year over year went from 2.8 to 2.9. Just so everybody has their all the facts for how they want to think about their trading. Everybody tuning in on Sunday night / Monday morning.
Steve, I want to get your thoughts on what Rick, this does to, as Mohamed El-Arian on CNBC earlier this week posited, the possibility that when you have signs of a strong and resilient economy, inflation that's been moving in the right direction but maybe getting stickier here in this quote-unquote last mile, whether the Fed actually does away with this 2% target or at least gets more flexible around it.
Yeah, so the old saw, Morgan, in economics was give them a number or give them a date, but never give them both, right? You've heard that before. And I think what the Fed is doing, it's given us a number, but it's not given us a date. And the way it's going to fudge around the goal of 2% is the time that it feels comfortable in getting there. You'll note... my question I got the first question to Chair Powell at the last press conference, and I said, Chair Powell, how is it possible you're raising your inflation target, but you're not changing, or you really haven't changed the number of cuts you expect? Well, what does that tell you? It tells you that they're going to be more patient in the process of getting to 2%. Of course, he said it meant nothing of the kind, but, let the numbers speak for what they say, essentially, which is, yes. So I don't think there's a huge difference here in terms of this number today and what it would say for the Fed. They raised their thing 2.6%. He says we were closer on the way there. So I think we do get I'm going to go out on a limb here and say 2 cuts, more than 1. It's like the Price is Right, just barely undercutting Rick on it.
Okay, Diane, I see you're nodding your head.
So you've taken a bite out of that carrot. You've taken a bite out of the Fed carrot. That's exactly what they want market participants to think.
Exactly. I actually agree with Steve. I think we're going to 2 cuts, but I also think what's important about this is the difference in terms of how the Fed talks about getting to 2%. Remember, they never got to 2%, and they talked about it as an inflation averaging on the other side of it in the 2010s. At some point in time, and I agree with you, after they get to close to where inflation is no longer an issue, and the issues that Rick speaks about, that price levels are no longer an issue for people. Once they get to that, and remember, they've got this years out on their 2%, achieving their 2% inflation target, they're going to be reevaluating what is the optimal. They've never really asked, what is the optimal target? Now, the question is, do they actually do that and come up with a different target or not? But they can't move the goalposts until this current bout of inflation, at least explicitly, has been won in terms of people feeling better about where they are in their incomes relative to price levels.
Okay, I want to bring another voice into this conversation.
And I want to make a very quick point on that, which is, and maybe Rick will come back and talk about this later, but the market is not demanding that of them either, Diane, right? So the market isn't saying, get there quickly. So they have that flexibility from the market, which is not where rates are not soaring. I'll leave it there. We'll talk about that later.
Okay. I want to bring in another voice to this conversation.
And one last thing on that.
Hold on, guys. CNBC contributor Victoria Green is going to jump in here as well, founding partner, chief investment officer at G Squared Private Wealth. She's here to sort of give us more on the market reaction, too. Diane, I'll come back to you, but first, Victoria, I want to get your initial reaction.
Sure, it seems mostly in line. Hot spending should help discretionary retail, bounce back from the bad numbers we saw earlier. Spending's great, but it's going to make things hot. But we've seen this before. Last month we had inline PCE and the market loved it. So yeah, it's a little sticky, a little hot. Honestly, now the market's kind of probably rooting for a weak employment number next week so that we can see Powell balance that out, right? So if we have weaker employment where he's paying more attention to that, could balance out, keep those cuts on the table. For now, I don't think there were a ton of surprises except the very strong spending and income, which were a little bit expected because we knew the labor market was pretty strong and we'd seen wages rise as well. So nothing really super surprising. Obviously not necessarily the numbers the Fed wants to see, but I don't think this is going to catch anybody off guard when they come back to work on Monday. And I think everybody's going to pivot to labor pretty quickly and say, well, maybe if we see some weakness and cracks over here, this little stickiness in the inflation and PCE isn't going to matter as much, which the markets have been able to blow this off. Even the bond market, considering how sticky these numbers have been the last few months, it really has been kind of a non-starter.
Diane, I know you had a thought before. Let's go back to you.
Oh, I just wanted to add to it, and this is, Victoria may have a view on this as well as Rick, and that is the Fed has now decided, and Steve, we know this, that they're no longer willing to take a recession to get this last mile of inflation out. That's part of the slower glide path. And the resilience of the economy is welcome news. And if it takes a little longer, rather than taking the pain of unemployment with grinding down inflation more slowly, the trade-off is let's grind down inflation more slowly and not have unemployment. And I think that is where the Fed is at right now. And I think that's an important thing to remember as well, because markets now see this as a soft landing or no landing scenario. And that's got to be buoying financial markets as well. And I was even struck by the fact that after investment being weak in the first quarter, the durable goods orders suggest that we're starting to see a pickup in investment even at these levels of interest rates, which speaks to the larger easing of financial conditions that we were talking about. But I think that's important as well as the resilience of the economy. The question is, the thing that Waller fears most about, and some on the Fed worry about, is are we going to reignite the cooling embers of inflation rather than it just gets sticky? And I think that's the thing that they're going to be concerned about. But for now, they're not willing to take a recession, and that's important too.
Yeah, Torsten Slok from Apollo was talking about that on Closing Bell Overtime yesterday as well. Rick, let's get your thoughts on that. Soft landing?
Yeah, well, here's the thing. I'm not buying into any of this because, to me, what we're really talking about here is guidance. In other words, do I really believe that when the committee, and especially Powell, was, I don't care if we have a recession, we're going to slay inflation. I didn't believe it then. That once the numbers started to deteriorate and a recessionary time was approaching, I would believe that they would have cut. Okay, so now he's just acknowledging what I would have believed anyway, what I think many market participants believe anyway.
All right, Victoria, I want to get your thoughts on. Victoria, I want to get.
It's different to cut. It's different to cut at 9% inflation than it is to cut at 2.5%.
Yeah,
if
Victoria, I want to get your thoughts on this though, because you are seeing industrial stocks and material stocks and some of these cyclical parts of the market trade at record highs right now. And part of the reason you're seeing that is because you do have this fiscal spending that is starting to hit the economy right now, too, on infrastructure, on chips, on, the Inflation Reduction Act, et cetera. And that's a secular growth story in of itself. How does that factor in here? Because, quite frankly, I got to think Fed officials are, even though it's not their lane, they're watching what's happening on the fiscal side and the impact it's going to have on inflation here.
And it should certainly help. And we've seen that government spending, government employment has been a large part of these gains here. And it does look set to continue with some of these policies starting to pay out significant chunks of capital to companies. And I think you're also seeing increases in productivity. You're seeing margins increase. You're seeing earnings expectations continue to rise. All of these things are good for the market and good for the economy. Technically, the Fed isn't supposed to care about that unless there's going to be a liquidity concern or a lockup or some sort of instability. But we all know that they can't can't not help but watch the markets and understand what effects they have. But generally speaking, it would be a surprise at this point to not have a soft landing, or quite frankly, a non-recession, because of the way these companies are trading. Look at oil prices have continued to increase, even with China continuing to be slow. Imports there very, very slow. We're seeing that market is still tight because they're seeing consumption. We're expecting a very strong driving season this summer. We're expecting travel to be strong. Expectations are extremely high for economic growth. I know Q1 GDP should come down from the blockbuster Q4, but at the same point, we are in a period of economic growth, and I think the Fed has to kind of take a little bit of an easy breath on that, because there are some supports and stability, and that's what the Fed wants, is the stability. I think it's a valid point that they are fighting a bit of a credibility battle. Are they going to sacrifice everything to get to that 2%, or and that, I think, is going to be the key point to them of can they remain credible? Are people going to believe when they say what they say in their dot plots, what they're saying in their commentary, or are we just going to say, well, they're going to be too late or too early, and they're probably going to get it wrong because they're in between a rock and a hard place. Either you potentially sacrifice economic growth and labor for the last mile of inflation, or you learn to live with inflation being a little high and sticky. I think the death knell is going to be if we see continued reacceleration in goods and an actual acceleration like we saw in the 70s and 80s, and that's the only thing that really concerns me. I can deal with sticky. I think we can deal with sticky, and this last mile might just get fudged over. But if it's not sticky and it does actually accelerate, that's the point then that all of these projections go out the window, because it's 70s, 80s again.
Okay, so I'm just going to go around the horn here, get final thoughts from everybody. Steve, it sounded like you had a reaction there.
No, I'm just interested in Powell this afternoon. I think we're going to be probably upgrading GDP when we do our rapid update early next week. We're looking for 198,000 on jobs. The economy's cooking along, and I love when the Fed is the center of attention. I do TV a lot, but I'm happy for a world, Morgan, where the Fed matters less and earnings and growth and jobs matter more. I think that's a better world to live in, rather than talking about equilibrium, neutral, inflation-adjusted rates. I'd much rather talk about growth and jobs and wages. And I'm really in Rick's camp, because I know the world he wants to see is one where the Fed dials back and has less influence on this world. I have really enjoyed watching the market make the decisions it's making. I don't think they're not in tune with what the Fed is doing, but it seems to be dancing a bit more to its own music right now, and I think that's a better world.
Okay. Diane, your thoughts on that? Are we getting closer to that place where the Fed is going to perhaps matter less?
Gosh, I hope so, and I agree with Steve on that. But on the market side of it, I think we also have to issue the issue about Gen AI. And I think that is important. We tend to see technological innovations trigger bubbles, and that actually helps you build out the infrastructure to get the full adoption over time. But we also know a lot of this market strength is generated by a few key players in the market. And that is something that also the Fed is watching. Does that make for instability in the market as well? And so I'd like to have the Fed completely in the background, like watching paint dry, as they once said about quantitative, the roll-off of the balance sheet.
Okay. Victoria, how are you positioning yourself ahead of Monday? And when we have, given the fact that we have seen this market rally broaden out, at least in recent weeks here, does that continue?
Yeah, absolutely. It was great to see energy lead last week. We see an energy, materials, utilities, they were all much stronger in March. And we did see the technology leadership flag, which I think is fantastic. I'm not saying I'm rooting for them to roll over, but having other leaders in there really makes and gives more and more credence to this bull market story, which it is absolutely a very strong bull market and still in early to mid innings. So I think people can't underestimate the strength of this bull. I think as long as the Fed does not have to come out with something out of left field, some sort of 180 policy shift. As long as we can keep kind of status quo, then the market should be able to run and the Fed can be murmuring in the background and we focus more on earnings. I mean, that starts up, 2 weeks, we really get into the meat and starting with financials. And look, we have stability in banking. Regional banking hasn't been an issue. Commercial real estate hasn't been the problem necessarily. We have all of these little potential fears lurking from, is this going to throw us off? Is the massive deficit going to throw us off? All of these potential problems, for me, I don't see them as actual immediate problems. I think they will continue to murmur in the background. The biggest risk, I would say, would be some sort of policy change announcement from the Fed that the market's not expecting. If we can get status quo, focus should be on earnings, which is where it should be, in my opinion.
Okay. Rick, or maybe I should call you Mr. Market after this conversation today. Last word.
I certainly hope that I'm going to shift back to the Fed. I certainly hope QT stays alive and well, because my fear is I would like a good outcome, Steve. But if we should ever have to fire up QE when the Fed's balance sheet's this significantly higher than it's been in the past, debt and supply and issuance is going to be the primary factor in determining more of where long rates go. So we want to be very cognizant of that. And if I had to make a guess as to how this data affects Monday, I would say that the Fed's going to have its cake and eat it too. I look for some curve steepening, which means short maturities like 2-year note yields will be well behaved, but I think long end will be a little more sticky.
All right. Victoria Green, Diane Swank, Rick Santelli, and Steve Wiesman, thank you all for joining me as we break down this key inflation gauge that we know the Fed watches so closely on this Good Friday. Appreciate it, guys. We also have full coverage of today's news on CNBC.com/pro. Throughout the weekend, Pro will get you ahead of Monday's trading. So there's a new story that's up right now about a key ETF focused on the chip sector. Potential it keeps running higher. We know it was a strong first quarter for the chips. And there's a call on Pro right now about why gold is the better investment this spring than Bitcoin. So go to CNBC.com/pro for that. Thank you very much for joining us here on this CNBC stream. We wanted to make sure to give you the news, the number, the analysis around this morning's key inflation data. So follow us all day on CNBC.com. We will be back live on CNBC TV come Monday morning. Happy Easter to everyone. I hope you all have a wonderful weekend. Thanks for being with us.